Welcome to the deep dive. Today, our mission is really to cut through some of the corporate speak. We want to get to the truth behind the latest financial filings from Tata Elxsi.
Right. They're a global player in design and technology services.
Exactly. And we're digging into their Q2 results for fiscal year 26.
And this quarter, management used that phrase resilient growth, which, well, it immediately makes you pause, doesn't it? Especially given all the turbulence we've seen across the IT sectors lately.
Yeah, resilient can mean a lot of things.
Exactly. So we need to peel back the layers on these numbers. We're trying to figure out where the real momentum is, and maybe more importantly, which strategic bets are actually paying off right now, or maybe not.
Okay, let's hit the key financial snapshot first then.
Yeah.
So reported operating revenue was RS9 18.1 crores.
Okay.
That's a sequential jump of 2.9% in actual currency terms.
Yeah.
But straight away, we need to look at that constant currency figure. That gives us, the clearest picture of the core operational growth without the currency swings muddying the waters.
And that constant currency number, the CC figure, that's really where that resilient claim gets tested a bit.
How so?
Well, on a quarter-over-quarter basis, QOQ, that CC growth slowed down to just 1%. Just 1%.
Ah.
So it shows that while they did grow, a pretty significant chunk of that reported revenue gain, it actually came from favorable foreign exchange movements, not purely operations.
Okay, but the profit margin story, that was certainly looking more encouraging, wasn't it?
Yes, definitely. PBT, that's profit before tax, it rose 9.4% sequentially. Came in at Rs 214.7 crores.
And the margin itself improved by 110 basis points.
Right. Let's just pause on that 110 basis points or BPS figure for a moment. For anyone maybe less familiar, a basis point is just 1/100th of a percentage point.
So a solid 1.1% improvement in their profit margin over just the last quarter.
Exactly. And the net profit PAT also grew. That was up 7.2% sequentially, hitting Rs 154.8 crores.
And geographically, there was one clear leader.
Yeah, the U.S. market was really the engine this quarter. It led the charge with pretty strong 7.9% growth quarter on quarter.
Okay, so that sets the scene. Let's unpack this properly. And I guess since transportation is well over half the business, we have to start there, in the engine room.
Absolutely. Transportation is, it's core to Tata Elxsi's identity, over 53% of their total revenue.
Right.
But this is exactly where the overall numbers got pulled down a bit this quarter. Sequentially, Q2 growth was really muted, just 0.7%.
0.7%.
Yeah. And if we look at that core constant currency growth figure again, it actually contracted, went down by 0.5%.
That feels a bit counterintuitive. I mean, we hear constantly about the huge demand for engineering services, right? Driven by software-defined vehicles, SDVs, electrification. Why did the engine seem to stall for them?
Well, management was actually very specific in their explanation on the earnings call. They said they faced a major sort of one-off headwind.
Okay.
It was due to a cybersecurity incident at one of their top automotive clients. And they even went so far as to quantify it. They said that without that disruption, the segment would have shown positive constant currency growth.
A cyber incident hitting a services firm's revenue like that.
It's unusual, but I suppose it's also a convenient explanation. Is there any other data that suggests maybe this is masking broader weakness in the auto market cycle?
That's a fair question. But the broader geographic performance seems to contradict that idea of overall weakness.
How so?
Well, the core automotive traction they're seeing in Europe, Japan, and India apparently remains pretty strong. Europe's still their largest market, remember, and they're seeing good demand there.
Okay.
The problem, as they described it, seems really hyper-localized, specifically within the core auto OEM business, but only in the U.S.
So what's unique about the U.S. right now that's causing that specific muting?
Yeah, management pointed to a couple of things, primarily a product portfolio reset going on among the big U.S. legacy OEMs.
A reset triggered by what? Two main factors, apparently. First, the withdrawal of certain EV incentives over there. And second, perhaps a bit more surprisingly, the relaxation of some emission norms.
Yeah.
It's kind of like, they plan this huge cross-country road trip based on one set of driving rules, and then halfway through, the rules suddenly change.
Right. They have to pull over and rethink the route.
Exactly. They have to redraw the map. And that forces a sort of temporary freeze, or at least a reduction, in certain R&D budgets while they figure out their new strategy, their new compliance approach.
Okay, that makes sense. So that makes the adjacent markets, the non-OEM auto stuff, even more critical then.
Absolutely. And they are pushing hard there. They mentioned adjacent U.S. markets like aerospace, rail, and even heavy off-road vehicles. Those are showing robust
Good
traction.
diversification.
Yeah, it helps diversify their exposure away from that volatile U.S. auto OEM segment right now.
Okay, now here's where I think it gets really interesting. Looking ahead, focusing on those future technology bets. Their long-term momentum seems entirely driven by these software-defined vehicle programs and electrification. Can you give us a really concrete example of that strategy working?
Yeah. The relationship they have with Suzuki Motors is, I think, a fantastic illustration of that long-term strategic depth.
Hazuki, okay.
They recently opened a second engineering center in India just for Suzuki. This one's in Thiruvananthapuram, and its focus is entirely on cloud hardware in the loop simulation, Cloud HL.
Cloud HL. Okay, that sounds incredibly technical. Why should you care about a Cloud HL center? What does that mean practically?
Think of it like this. They're creating a completely virtual, a digital twin of a car's entire electrical and software system, but it's hosted in the cloud.
Right.
So instead of waiting weeks, maybe months, for a physical prototype car to test a software update.
Which is the old way.
Exactly. Suzuki can now run millions of miles of testing and validation almost instantly, virtually, in the cloud.
Wow.
That massive acceleration of the SUV development lifecycle, that's the game changer, and it builds a really deep, long-term, multi-year, multi-million-dollar relationship. It's sticky.
And that ties directly into that big strategic pivot they've been talking about, right?
Yeah.
Moving away from just serving tier one suppliers and focusing directly on the big OEMs like Suzuki.
Precisely. They confirmed they've been actively executing this pivot for the last, 8 quarters now? 2 years.
Right.
And the goal isn't just revenue size, it's about stability and getting access to that really high-value, deep engineering work that OEMs control. And importantly, they said this strategy has finally led to the Tier 1 part of their business stabilizing this quarter.
Meaning the drag from that sector is finally lessening.
Hopefully, yes. That seems to be the message.
Okay, that sets the table then for what management hopes is a much better future. They sounded quite positive, aiming for the second half of the year, H2, to be significantly better than H1, with a really ambitious goal, achieving double-digit growth for the entire transportation business in the next financial year, FY27.
It's ambitious, definitely, and it rests heavily on the success of these big strategic partnerships and these new tech centers, like the Cloud HIL one.
Okay, makes sense.
But let's shift gears now. Let's look at the other core segments, because they had quite different stories in Q2.
Let's talk about media and communications, M&C. This was the segment that really rallied, wasn't it?
It certainly did. M&C makes up over 31% of their revenue. And it delivered very strong sequential growth, 6.8%.
Wow.
Or 3.7% in constant currency. So still solid growth even adjusted. This was a clear success story for the quarter.
What drove that?
Primarily fueled by the ramp up of those large deals they'd announced in previous quarters, plus some new deal wins coming through.
Can you give us a specific example, a product win maybe, that showcases what they're doing in M&C?
Yeah, a really good example they highlighted was their involvement in the launch of something called MBC NOW.
MBC?
Yeah, it's a big content super aggregator platform for the Middle East and Africa. And the key thing, it's powered entirely by Tata Elxsi's own proprietary in-house OTT platform. It's called T-Play.
So they're not just integrating other people's tech, they're selling their own platform.
Exactly. It shows they have the capability to take their design and engineering muscle and actually turn it into a marketable product for major international broadcasters. That's a big step.
But there's always a but, isn't there? There's a note of caution here too, right? Volatility seems to be the name of the game in media.
It really is. The industry remains pretty choppy, subject to M&A activity, corporate shakeups among broadcasters and operators. So management, quite realistically, I think, expects this really strong sequential growth to actually moderate somewhat in the second half, H2 FY26.
Okay, so a strong quarter, but maybe don't expect that pace to continue
Oh,
indefinitely.
it seems sensible, yeah.
All right, now for the other side of the coin. Healthcare and Life Sciences, HLS. This segment saw the biggest retreat this quarter, a 4.6% decline in constant currency. What happened there?
Yeah, that decline, it looks steep on the surface, but it seems to have a very specific cause. They said it was primarily due to the natural conclusion of several large regulatory programs, specifically MDR programs.
MDR, medical device regulation.
That's the one. These are often massive but finite projects. They're designed to get medical device products certified under new European compliance rules, for example. Once those projects successfully conclude, well, that specific revenue stream naturally drops off.
Okay, so similar theme to transportation in a way. They're focused on replacing those maybe lumpy project-based revenues with longer-term, more strategic relationships.
That's exactly the strategic pivot here, too. They're trying to build a more sustainable foundation for growth. And they announced a big example of this, the launch of a dedicated global technology center for medical devices, specifically for Bayer.
For Bayer, the pharma giant. Okay.
And it's focused specifically on radiology. The goal is to co-develop advanced devices focused on enabling earlier diagnosis.
Sounds significant.
Management clearly views this collaboration as a kind of bedrock for the segment, something that should provide stability for at least, they estimate, 3 years.
So short-term pain from concluding projects,
Well,
but a long-term investment in stability. And interestingly, just like transportation, management sounded confident about a recovery in H2 here too.
Mm.
And they're also targeting double-digit growth in HLS for FY27.
Yes, same ambitious target for both key verticals. It shows where their focus lies. Before we jump to the really critical discussion around margins, we probably should mention the smallest segment, system integration.
Right, the niche player.
Yeah, but this niche segment actually showed the highest growth rate of all this quarter, a whopping 20.5% QOQ.
20.5%. And they got some external validation for that too, didn't they? Something from Dell.
They did. Won a global award from Dell Technologies, Best Infrastructure Solutions Group Supplier of the Year. And that's tied directly to the work they're doing delivering infrastructure solutions for, you guessed it, AI data centers and edge computing.
So clearly connecting them, even in that smaller segment, to the hottest growth areas in enterprise tech right now.
Absolutely. Okay, now let's talk margins, because this is where I think we find the real operational story underneath the headline numbers.
Yeah, the PBT margin improved by 110 basis points sequentially. Looked good.
Yeah.
But as we noted earlier, the overall revenue gain relied pretty heavily on favorable currency movements, on FX.
It did, and the CFO actually detailed the margin walk on the call. This is a really critical nugget of information for you, the listener, to grasp.
Lay it out for us.
Of that 110 basis point gain in PBT margin, 90 basis points, 90, came purely from favorable currency movements.
90 out of 110. Wow. So that means only 20 basis points of margin improvement was actually organic from the operations themselves.
That's the key takeaway right there. The improvement was largely non-operational this quarter. And what actually set potential organic gains were higher costs elsewhere. Higher people costs. That shaved off about 40 basis points, mainly linked to bringing campus hires on board and strengthening our sales team. And then another 30 basis points came from higher infrastructure costs, mostly related to setting up new AI partnerships.
So if the organic margin gain was, frankly, pretty marginal, then the future recovery story has to hinge entirely on efficiency, right? Getting more out of the people they have.
100%. Their operational focus now seems hyper-focused on utilization, getting billable hours up.
Where are they now and where do they need to be?
They improved utilization from a maybe slightly low 66% up to just over 70% in Q2, which is progress. But the mandate from management is relentless. They need to reach 75% utilization by the end of this fiscal year, FY26.
75%.
Yeah. And management explicitly noted that achieving this 75% goal is absolutely critical for margin recovery in the second half, especially because they expect wage hikes are coming up soon. They basically need every engineer billing as many hours as possible.
Okay, so let's transition that into their overall future positioning then. How are they weaving together this intense operational efficiency drive with the bigger technological future, particularly around AI and SDV?
The strategy seems brilliantly two-pronged, actually, and very clear. First, they're focused on just operating better.
How?
Using generative AI internally. For productivity gains, for quality improvements. A perfect example they gave is their partnership with KVIA AI. They're using a Gen AI-powered platform for the software development lifecycle, basically making their own engineering work cheaper and faster.
Makes sense. Use the tech yourself first. And the second prong, that's not about internal efficiency, is it?
Correct. The second prong is innovation and features. This is about leveraging AI directly in the products they engineer for clients.
Like ADs.
Exactly. Integrating AI for advanced driver assistance systems in cars, or like those advanced predictive analytics we talked about in the radiology devices for Bayer. This is where they drive features, capabilities that simply didn't exist before AI.
And to make all that happen faster, especially in the really complex auto sector, they've clearly bet heavily on virtualization tech too.
They absolutely have. That partnership with Synopsys, for instance, it's all about accelerating SDV development through virtualization. It enables much, much faster testing and development cycles for these incredibly complex car systems compared to just relying on physical prototypes.
Got it. Okay, one final operational point we should touch on. Headcount actually declined slightly this quarter, and attrition, the rate people are leaving, has ticked up marginally for the third straight quarter. Seems like they're managing their bench strength very, very tightly.
They really are. It sounds like they're essentially holding back on large-scale recruitment until they actually see that promised revenue acceleration materializes in H2.
Waiting for the proof.
Yeah. They expect attrition will probably stabilize, maybe even improve, once that growth visibility becomes clearer for everyone.
Okay, so if we were to summarize the main theme of Q2, it feels like despite all the external volatility, the cyber incident, the U.S. regulatory confusion, those big regulatory projects ending in Polthker Tata Elxsi is strategically planting some very deep and probably quite expensive seeds for sustained long-term growth.
That's a great way to put it. It's a classic balancing act, isn't it? Those really aggressive goals for double-digit growth in both transportation and healthcare in FY27, they hinge entirely on executing two strategies successfully.
Which are?
First, maximizing that utilization metric to deliver genuine organic margin recovery. And second, successfully weaving those advanced AI and virtualization capabilities, things like the cloud HL centers, the Gen AI partnerships, deep into these strategic customer programs. Programs that will hopefully deliver revolutionary cars and medical devices, but maybe years down the line.
Yeah, paints the picture perfectly. The trade-offs, the investments being made right now. And this leaves us and you, the listener, with a final provocative thought to maybe mull over. We've seen the company pivot really aggressively towards OEMs and this complex SDV technology, locking in these multi-year contracts. Now, considering the global automotive industry's incredibly high-stakes race, particularly against fierce Chinese competition, will this focus on deep, long-term engineering partnerships provide the kind of defensive moat and sustained growth they need? Or perhaps will the notoriously slow pace of R&D cycles at some of these legacy OEMs eventually frustrate Tata Elxsi's really ambitious FY27 targets? Something to think about as you track their performance in the quarters ahead.